All right, everyone, welcome to video number 3. This one, I want to describe the algorithm, the candlesticks, the thing that we trade every single day. This is the algo. Well, it's many algos pieced together, but the intricacies of it can be confusing. So we focus on what we can trade and the simplicity and things that can be repeated. But you need to have a basic understanding of what the algorithm does to truly appreciate what we're trading. So we'll go deeper into all the intricacies of it in the future lessons. This is just going to be a basic overview. So the algo. The algorithm always has a start time, and that initiates a look back function. So we're using 8 a.m. Central Time as an example. The algorithm runs on Central Time. It's based off of the CME timeline, which is the Chicago Mercantile Exchange, which is UTC-5. So the delivery systems run off Central Time. The reason being is because they wanted to create the algorithm as close as possible to the initial Chicago Mercantile Exchange timeline, way back before trading was electronic. They had specific times of the day that orders would be processed, submitted, filled, different things like that. So for latency purposes, the algorithm's delivery system runs off of Central Time. So if we're using 8 a.m. CST or UTC-5, we mark a vertical line and a horizontal line on the opening price at 8 a.m. So if this is the start time, and this initiates a look back function in order for it to keep moving forward. So looking back to cast forward. Then at this point, we need to see what's happened in the previous range or previous start time. So 2 a.m. in the morning and 8 a.m. are ones that we're going to be focusing on a lot and going into it a lot deeper. But the key point to this is to understand that we have to look back as traders to understand where we were, to try and predict or anticipate where we're going to go and how we're going to get there. So when you get to the charts, you have your start time, whatever that may be, and then you look back to see what has happened. It's very, very important because people can get lost in the candlesticks as they move, and we don't want to do that. If you don't know where it's going or you don't have um, key levels marked out or an idea of what may happen through the day, then you're just buying and selling and it's more of gambling. So that is the first key function of the algorithm. After it starts, it's going to create imbalances. Imbalances being one-sided candlesticks. So on my chart, the black candles are down candles and the red candles are up candles. Those are just the colors that I have. I switched them up so people wouldn't copy my charts a long time ago. But for understanding purposes, black is down, red is up. So imbalances are if we have a start time here and we have multiple down candles. This creates an imbalance because there's no up candle. Down here, we reference price booking needs a buyer and a seller to balance the book, which means every up candle needs a down candle for that portion of price to be balanced. So the algorithm creates imbalances and then it fills imbalances. Once we start putting up candles back inside of these down candles, now this portion of price right here is balanced. So creating inefficiencies, filling inefficiencies. After we close down here, we now have an inefficiency with this down candle. And then we start filling it here. Down candle, up candle. So in between these 2 points is now an imbalance because there's only a down candle there. Until this candle closes and balances this whole portion of price, the algorithm is going to continuously seek to fill imbalances created after the start of time or deliveries. The other thing it does is engineer liquidity. So liquidity comes in the form of failure swings, equal highs and lows, 3 candle swing highs and lows, and anytime we have internal liquidity left in a range. So first point I want to make is the failure swing. A failure swing is when the next candle fails to take the high or the low of the previous candle. So if we zoom in here, as these candles are moving down and creating imbalances, they're also engineering buy side liquidity. Buy side is on top, sell side liquidity is on the bottom. When we're running up, we're running for buy side liquidity, and in this case, to fill imbalances. So the algorithm is going to see where the resting liquidity is. Once a candle takes the previous candle's high or low, there's no more liquidity on that candle because we've already taken liquidity from the candle before it. So there's different things we expect to happen there. Our targets are going to be failure swings because that's what the algorithm's going to search for. This is the purest form of liquidity. It hasn't taken any liquidity anywhere. It's just sitting here resting. When they cluster like this, these are things that you want to be aware of because that's when you can expect speed. We've got a lot of liquidity and we can cut through that like a knife through butter. It's low resistance, just like what happens here. So it engineers liquidity and then it runs to pair orders at liquidity. Like I said, for every buyer, we need a seller. So it's going to run to pair buy side and sell side at liquidity points. Equal lows and equal highs can be forms of liquidity, but the main one we focus on is going to be the failure swings. They're the highest probability liquidity. When this initial run closes here and we trade up inside of it without closing above the origin of this sell, this becomes a pure form of internal liquidity. So once we trade back down, completing this fractal, we can expect this to get taken. So these are little areas of liquidity that we're going to continuously go over. I just wanted you to get familiar with part of them. So right here, this candle's low. This is a failure swing because it failed to take the low of this candle. This candle took the low of this candle, so there's no liquidity here. As you're going to learn in future lessons, your stop loss is safe here because there's no liquidity for the market to run and grab. But if you put your stop loss here, it's acceptable to being run because that is resting liquidity. Although it doesn't get there now, it will eventually search for that. A lot of times, like right here, this failure swing got ran by this candle. So they paired liquidity here to then go higher, which is what they could have done here. So we protect ourselves. There'll be a lot more on that on future lessons as well. So the algorithmic delivery system runs on time-based. It's a time-based system off of the CME, Chicago Mercantile Exchange. So when time starts, it initiates functions to navigate to and from certain price levels. The price levels can be hidden, so we use structural references to guide us. When we go through the key levels section, there'll be a lot more on that. But the algorithm knows price levels. So the start of time, 8 o'clock, is an algorithmic price level reference. because this is the beginning of time. So when we move away from it, as we're coming back, it's going to remember this, and then anything that's formed inside of it. There's a lot of these key levels that are on the chart constantly. If we had all of them on, we wouldn't be able to see the chart and it would do us no good. But there are a lot of reference points and key levels we're going to go over in this course so that you're going to be able to understand where price is going and where it's going to turn around and how to read them. So key levels and then deliveries. So there's two delivery systems that we're going to be focusing on, and they're the ones that deliver price constantly. So these two deliveries, delivery one, delivery two, are going to be the main focus. So when I talked about trading and understanding as opposed to trading candlesticks, this is how the market delivers price algorithmically. These are all timed functions. They're not just patterns. There's an understanding and an order to this delivery. And once this is understood, you can trade every piece of this delivery. So this fractal could be on a 1-hour chart, and this fractal could be happening down here on a 5-minute chart to get us over here. This fractal could be happening up here. If we understand where we're at in the overall fractal, we can trade every leg of this fractal along with the second one. The market's always moving in waves. This is more of what it looks like. Delivery one can show up all over delivery two at turning points, because this is more of a reversal pattern and this is more of an overall market structure. But you're going to learn each piece of these and the key levels inside of them that we reference so that we can wait for what we want to see happen and then trade it accordingly. So for an assignment, just mark a vertical line on 8 a.m. and a horizontal line at the opening price, and then study how price moves around that level, how we move away from it, how we move back to it, how we can bounce off of it, how we use it as support and resistance. All of that stuff will start to train your eye to see how the market's moving based off of this understanding. So when somebody looks at the market for the first time and sees all this randomness, that's where confusion and doubt comes in. So once you have this understanding and you go to the chart and you know that a start time has to happen, we need to look back to see what's going on, and then we know what the algorithm is doing and what it's searching for, it doesn't become such a jumbled up mess and it starts to make sense. Imbalances are created and imbalances are filled. The way we do that is through engineered liquidity, pairing sell side with buy side. You've got a failure swing here. Down close candle is accumulation. We close above its opening price, and then we're going to continue searching for failure swings. So this will condition yourself to always look left. Instead of focusing on the candlesticks that are printing, we need to look left to see what we're aiming for and what piece of delivery we're in. I don't know if you can see it from right here, but delivery number one, right here. And this is today. The market's actually still moving. So it played out nice. But this, a lot of people call it accumulation, manipulation, distribution, different types of things. We're going to learn more about that in the next lesson. But get familiar with looking at price this way. Not being all confused, not just looking for a pattern, but understanding why things need to happen, what needs to happen, where. And this will start to open your mind to not seeing randomness and to be start becoming more of an algorithmic trader and a calm, concise, I hate to say, but smart trader. So yeah, go through this assignment as much as you like. The more you do it, the better you're going to get at it. So I can't say, it's hard to say, just do it, 10 of them, stuff like that. Just when you got free time, go through different days, just mark this price and start to get familiar with it. So cool. I will see you on the next one.